Welcome to the latest structural research webinar. Apologies, it has been a little while since we did something like this, but I guess we were hoping to, get on airplanes and visit you all in person, but that's been a bit of a slow roll. So here we are again in the wonderful world of webinars. But we do, feel and remain optimistic that this year will be different, and hope to see many of you in person at some point in the year. Travels to the APAC region are definitely high on our priority list, and apologies again that we have not been able to make it. So hopefully this will do for now. Today we're going to talk about the hyperscale data center market, so a conversation focused specifically on this category. Thank you again to Digital Realty for sponsoring this webinar. We hope that we will also get a chance to do something live and in person, and of course in the region. Just want to, Jabez is going to kick off the presentation here, but before I introduce him, and I think many of you know him, but as you know, Jabez has done just amazing work over the last 8 years, covering not just the global data center market, but zeroing in on many of the very interesting and unique markets in the Asia Pacific region. Just to give you an update on where we are in terms of our research roadmap and what we've done. 2021 was very busy. Jabez churned out 3 updates basically in the second half of the year, finishing up Japan, Australia, and Hong Kong. He is in the midst of the Singapore update, waited for the moratorium developments and the news coming from that. We'll have a discussion on that as well. And 2022, we are pretty excited about not just updating our Jakarta report, but also adding and widening our coverage in the region. Our next, I think what you should expect to see from us in the first half of the year on top of the Jakarta update, as well as the Singapore update, is a Singapore overflow report, which we're really excited about, which covers both Batam, Indonesia, and Johor, Malaysia. And as we speak, Jabez is busy working on something for the Manila market. So you should expect to see all that in the first half of the year. And then in the second half, I don't want to kind of overpromise, especially and overcommit Jabez, which I am prone to do. He is definitely looking at, hopefully one of Mumbai and Seoul, South Korea to add to the list. So anticipate a pretty busy year, and hopefully that'll be, the research will be augmented by site visits and in-person conversation. So Jabez, we'll take over.
Great, thanks, Phil, and thanks everyone for joining. Let's just jump straight into it, since everyone's time is valuable, and we just want to give you as much of the hard-hitting content and insightful content that we've been producing on our side, that we've been working really hard on, hence not being able to do a lot of these webinars. So we promise we've been trying to get as much data and insight on the markets as possible. And wanted to start you with a refresh of our data center co-location taxonomy. If you notice, this is the rubric that we've been working off of for the last sort of 3 to 5 years. There's a clear delineation between retail co-location and what we call hyperscale co-location, and that includes also a smaller chunk of that enterprise wholesale market that we've now lumped into the overall hyperscale co-location market, given that it's largely overweight on the hyperscale side, given the hyperscale clouds have been the primary driver of demand and leasing, not just in that segment, but in the overall data center industry in total. So you can see these are how we've been defining those segments. It's easy to just look at the capacity numbers and say, okay, this is X kilowatts or X megawatts, and therefore it's this type of deployment. But there's also other aspects to it that we want to bring to your attention here in terms of customization levels, the way to bill power, carrier density, contract lengths, infrastructure environment. So that all plays a part in the structure of these deals and how we define it in our taxonomy. But what we want to do today is provide a little bit more granularity and insight into the hyperscale co-location section of our taxonomy. We do see a lot of movement and a lot of activity being coming out of this space. So we want to sort of bring to you that, hey, there's 2 segments within hyperscale that we're looking at. One is core hyperscale, and the other, the more newer nascent part of it is called what we call edge hyperscale, for lack of a better word. And so what's included in core hyperscale, right? It's something that a lot of you may be familiar with. It's the very sort of traditional hyperscale deployments that a lot of you in the data center industry are familiar with, from the co-location standpoint. Leasing capacity from third-party operators has been the norm for many, many years in the industry, especially from the hyperscale side. But increasingly, what you're seeing from the market is the influx of real estate developers, land developers that are doing, and even co-location companies are doing more sort of built to suit type deployments with hyperscalers in that 20 to 50 megawatt range. I mean, that's not a hard and fast rule. It could be a little bit smaller than 20, it could be more than 50, but generally it falls within this range of 20 to 50 megawatts in terms of scale when you talk about these single tenant dedicated built to suit buildings for hyperscalers. And then in addition to that, what we're also seeing across the world in select markets and select situations is hyperscalers choosing to self-build in markets where they either have access to large amounts of land, power, incentives from government, access to renewable energy, or it's just a very important tier one market for them to be investing, and also very low risk of them quote unquote overbuilding in that market. And so you see self-builds popping up all across the world, not just in Asia, but also in Europe and North America, and you'll see it in other markets too moving forward in Latin America and as well as Middle East Africa, I'm sure. So this is generally how we've viewed the core hyperscale segment. Probably not very surprising to most of you. But I think what's interesting is what is going to be happening on the edge hyperscale side. And Phil and I and the team have worked really hard to try and give some initial definitions. I mean, these are not by any means perfect because of how nascent and how rapidly evolving these segments are. But you have the more traditional edge hyperscale deployments that everyone knows, we call them network on-ramps or cloud on-ramps, that typically reside within carrier dense or carrier hotels in markets across the world, where it can range from as low as 200 kilowatts to 2 megawatts, depending on the market. And those have been around for a while as a way for hyperscale clouds to on-ramp customers to their compute nodes that may be located in further out areas from the downtown core. But increasingly, what we're seeing is hyperscalers start to deploy more edge-like infrastructure. So a good example would be AWS Local Zone, that they've recently announced some additional regions all across the world. We'll focus on some of them, particularly in the APAC region. But these are essentially the hyperscalers' way of deploying their cloud infrastructure in emerging markets where they don't yet have the confidence to deploy a full-on cloud region and full sort of traditional 3AZ structure that they like to deploy in major hubs like Singapore, Hong Kong, Sydney, Tokyo, for example. So these local zones may be a great fit for emerging markets like Manila, like Bangkok, other markets across India that may not yet warrant a full-on cloud region, but still present a significant opportunity and upside for the hyperscalers to gain more adoption on the cloud computing side. So that's something that we're monitoring and develop and watching it closely as they develop. Another thing that we've been seeing primarily happening in the North America market is what we call proximate compute nodes. And these are, they kind of blend between on-ramps and core compute nodes in the sense that they are relatively large, above 2 megawatts, but they're situated in very close proximity to carrier hotels to the extent that there's enough land and power or capacity available in close proximity to existing carrier hotels in the market. So we've seen that play out in markets like Columbus, Ohio, where there's been some sizable proximate compute nodes being deployed in that market, and still very nascent. We haven't seen that materialize in other parts of Europe and APAC just yet, but seeing some of that happen in the North America market. So maybe I'll stop there. Phil, if you have anything to add, feel free to jump in. Otherwise, I can move on to the next slide.
Yeah, maybe just a quick add. I would say, that's interesting when you brought up the examples. I think we have seen kind of I think it's a good way to describe it, which is kind of kind of the blurring line or a mix between an edge node and a kind of a core availability zone. I would say that we have seen something like this. I think Equinix's xScale builds, in certain cases they're quite large, but in Paris, for example, we've seen where the data halls for multiple cloud providers are around in that 2 to 3 to 4 megawatt range, and in close proximity to a very rich ecosystem of networks and carriers and a lot of interconnection capabilities. So definitely something that's starting to pop up, North America, Europe, and before long, I think, once, the footprints get even larger across the region, you're going to start to see that in Asia.
Great. And so without further ado, let's just dive into some of the market sizing numbers that you guys know us best for, and how we've been kind of trying to capture the data side of the market. This is from our recent global colocation report that we tend to publish once every year. This came out a month ago, and really an update on the size of the market as it relates to the critical IT, built out critical IT capacity by region in terms of megawatts. As you can see here, the APAC region is by far, not by far, but it is the largest region in the world as of 2021, eclipsing the North America market. And then you have also the European market, the EMEA market, growing at arguably the fastest growth rate if you don't take into account the Latin America region, which is still at a very, very small, growing for a very small base. Therefore, you see that high 25% CAGR for LATAM, which is not surprising, but we see a lot of growth happening in EMEA, and Asia Pacific is also growing at a very robust growth rate, 11% CAGR, given the extremely kind of high base. It's more than 2 times the size of the EMEA region. So for Asia to be growing at 11% CAGR over the next 5 years is fairly impressive, and speaks to the nature of how there's a good mix of very mature tier 1 global markets, as well as emerging markets with extremely high upside in the region. And we'll talk through some of those markets moving forward. North America continue to see stable growth at around 7.5% for the next 5 years moving forward. And so we do expect that to continue, especially as other sort of tier 2, tier 3 markets across the US start to develop and come up. So from a market share standpoint, as you can see, Asia Pac will maintain roughly a 41% market share of the global data center market as it relates to the built out megawatt capacity. And it's really the EMEA region, given the 15% CAGR, that's going to be taking away market share from the North America region. And as well, you can expect the Latin America region to slowly gain market share as more and more deployments from cloud providers happen across the LATAM region. But just to put it in perspective, right, we talk about CAGRs, and CAGRs can be misleading because a lower CAGR doesn't mean it's growing slower, when in fact in the Asia Pacific region, if you were to average it out, around 1 gigawatt of capacity, we're projecting at least 1 gigawatt of capacity coming online in the APAC region per year for the next 5 years. So that's significantly higher than EMEA, North America, and Latin America, which speaks to, again, the overall scale and size of the region and the amount of eyeballs that are residing within the APAC region. So that's accounting for over 40% from the previous slide. And as a global total, 2.5 gigawatts of capacity are projected to come online on a per year basis. So if you take the total capacity that we're projecting to go from now to 2026 and divide that by 5 over a 5-year time frame, on average, roughly 2.5 gigawatts of capacity will come online each year for the next 5 years, which is staggering for the industry. And that's why you're seeing a big push in terms of sustainability, corporate governance, and ways to incorporate renewable energy into such a large consumption of energy across the world. But just looking at the top providers in the APAC region, as you can see, a majority of that are Chinese based, but you also have international multi-regional providers like Equinix and NTT, also part of the mix, as well as sort of large telco incumbents like KT and KDDI in Japan and Korea. But a lot of the leaderboards here, as you can see, are from the Chinese market. No surprise, given that China is one of the largest and most mature markets in the APAC region. But you also see other providers like Tokyo and Singtel and SCT GDC make the list as well. And looking at this from a more qualitative standpoint, we like to produce these what we call market maturity indexes to give you a visual sense of how each of these markets in APAC stack up against each other. As you can see, we have the sort of traditional tier 1 markets highlighted in red in the top right hand side of the graph. And so you can see it's the typical markets that you're familiar with. We have Tokyo being the most the top market in terms of growth and upside moving forward, given how nascent the current cloud adoption is in that market. But that's also changing as more and more developments and more deployments and data center activities happening in the greater Tokyo area. Singapore has sort of made it to the bottom end of that list, primarily impacted by the moratorium and also the sort of the limited easing of that moratorium that we've noticed happened this year. And we'll talk a little bit more about that later on in the presentation. But you'll see Sydney as well, very strong activity coming from Sydney in the last 12 months. A lot of development activity happening there. Just outside the tier 1 markets, you have what we call the opportunity quadrant, which is essentially tier 2 markets. Some of them are currently tier 2 markets in terms of size, but we fully expect markets like Jakarta, Mumbai, and Seoul to eventually join the sort of tier 1 market ranks and be part of that red section in the top right corner. They're currently in early stages of ramping up and accelerating from a data center infrastructure growth standpoint. But also there's interesting things happening outside of Jakarta, Mumbai, and Seoul, which we think are sort of the most interesting tier 2 markets in the next that we'll see a lot of investment activity and cloud deployment moving forward. But you have markets like Manila and Bangkok. Phil talked about the overflow markets like Batam and Johor. And you have local zones popping up in places like Auckland, Chennai. So very, very sort of a mixed growth profile for a lot of these emerging markets, and not all of them will rise at the same time. The hyperscalers definitely have a limited procurement team, and so you'll see them prioritize certain markets over others at any given point of time. But as we've seen play out over the course of the last 2 years, there is a decentralization of hyperscale and cloud infrastructure happening on a global basis, and that's driven the need for cloud infrastructure to be deployed in local markets. And so we do expect a lot of these emerging markets to grow and develop over time and accelerate. Just to give you a sense for how the top APAC markets stack up with the top European markets. In Europe, they have FLAP. In Asia, we have JASH, short for Japan, Australia, Singapore, and Hong Kong. As you can see here, Tokyo is the largest market. We think today and will be the largest market by 2026, even larger than London, even though London is also experiencing a lot of activity happening in that area. Our European analyst has been tracking very closely the developments that are happening in that market, and we do expect to produce a London report fairly soon. But as you can see, London and Tokyo step in step over the next 5 years in terms of growth profile. Then the next tier, you have Frankfurt and Sydney that have seen a lot of activity from cloud and data center operators. And then the next tier would be sort of the Amsterdam, Singapore, Hong Kongs, and Parises of the world. Paris is notable because it's starting from a smaller base relative to most of these other top 8 markets. And it's definitely going to sort of outperform it in the next 5 years, given the amount of capacity that we're seeing coming online in the Paris market that our team is tracking. And we have produced a Paris Marseille report, and we'll produce an update fairly soon to update you guys on what's going on in that market. So yeah, lots of growth happening in all these major metros, despite this sort of edge movement and decentralization movement happening in a lot of the emerging markets in Europe, in EMEA, and across the APAC region. But looking across the other markets that are non-JASH in the APAC region, as you can see, we're very bullish on the future growth prospects of Seoul, Osaka, Mumbai, Melbourne especially as well, given that the hyperscale clouds have announced separate cloud regions in Melbourne in addition to Sydney. Jakarta is no surprise as well. A lot of people in Asia have long expected Jakarta to be a major player. I would also say, given the recent developments that we've been tracking in the Manila market, we do expect Manila to, this chart probably needs to be revised, and Manila needs to be moved up higher in the ranks moving forward, given the amount of development activity and the amount of demand that we're seeing entering the Manila market over the next 2 years. So, and that's reflected in that market maturity index slide that I showed you earlier. We bumped up. I managed to bump up that slide, but haven't yet updated this slide that we produced end of last year. And yeah, I think good time to hand over to Phil as he talks through what he's seeing on the hyperscale cloud side, how that's going to impact the colocation industry in the APAC region. So Phil, over to you.
Hey, thanks, Jabez. Great insights. So yeah, just picking up where Jabez, mentioned, I think we mentioned decentralization. And so when we think about, I think, the big story in this sector when it comes to, wholesale and hyperscale data centers is obviously the demand that's coming from the major public clouds. That's a pretty small an elite group, and they've built relatively centralized footprints in the APAC region around places like the Jash markets, and it's why Jabez has spent kind of the first phase, the first kind of good part of 8 years tracking these markets and following them. And now we're kind of hit that tipping point where this decentralization push is speeding up. One could argue that the pandemic has accelerated that. I won't disagree. And so what we're seeing is two things. So a move out to second tier markets, and then a shift in terms of how the hyperscalers are deploying. And that's why, we spend a lot of time following local zones because it's a very, it's a very interesting kind of picture into at least what AWS and probably how, in very similar fashion, other hyperscalers will think about how they build as their footprints become more distributed around the world. So I like to just look at the AWS map because I think it's, if you just look at their footprint in the United States, actually this includes Canada as well, North America, you'll notice that the red is where their core regions are. And they're, as you'll notice, off to the coast, to the east and to the west, and there's pretty much just nothing in the middle. So starting in late 2019, they came up with this concept called local zones, which is basically a smaller version of availability zone, 1 to 2 megawatts, 100, 150 racks, in a metro that's outside in these kind of gaps in the map where they can kind of position infrastructure, place it closer to end users, but still have it connect back to a core region. And so you'll notice in that time, in roughly 2 years, those blue circles have started to dot up, and I think they have 16 locations in the US now. And what's really interesting, if you move to the next slide, Jabez, is that just last week, I think it was, well, at reInvent, they announced their intentions to take this concept globally, covering APAC as well. And then last week, they revealed, which, they mentioned only countries then, but now they've identified the metros that they plan to build out local zones in. And I think this is a really, really good picture and a good window into, kind of where hyperscale demand is going to go. I think the very, I think, encouraging aspect of local zones for you in the data center business is that these increments are not going to be at the scale where a self-build kind of model becomes a bit more feasible or a bit more, logical or rational from an economics perspective. These are new markets. So I think the co-location, I would argue that the majority of these deployments, at least in this first, and if not the second wave, are going to find their way into some kind of co-location environment. They're obviously going to be also strongly considering facilities that have good connectivity. So if you look at this map, I think it's really interesting, kind of the metros they've picked in Asia. I think in particular, I want to just quickly zero in on Southeast Asia, which has been, I think, it's been a region that's gotten a lot of attention, primarily served through Singapore for the better part of a decade. But now, you're starting to see hyperscale Indonesia being a large enough market to justify in-country regions, Malaysia as well for some of the other hyperscalers. But in the rest of Southeast Asia, which has significant scale and a lot of the same kind of positive demographics and trends, are we going to see hyperscale clouds there, and are they going to be there to consume data center co-location? I think the answer from the Chinese public clouds is yes. They seem to be moving along in that process. But AWS seems to be, looks like, at least for places like Thailand, the Philippines, and Vietnam, we've heard rumors that they've been considering a full out region with 3 availability zones, but it looks like they're going to take a more conservative approach, wait for the market to develop, but they are going to set up local zones, and that's how they're going to serve in country in some of those places. If you look at Australia, I think just quickly is another interesting place, given that's already a dual what we like to call a dual hyperscale market with Sydney and Melbourne. But would they build a third one? Probably the size of those markets doesn't justify it, but a local zones deployment makes a lot of sense in terms of getting close to other clusters of users. Again, 1, 2, megawatts. What we're hearing through the grapevine is that, at least on a global basis, I use that 1 to 2 megawatt range, which is kind of the feedback we've been getting. We've got an interesting bit of feedback that points to, in places like a Thailand or Vietnam, where the market is quite large, and the growth potential is there, that these local zone deployments may start a bit bigger. They may be in the 2, 3, 4 range. And so, because they are essentially a replacement or a kind of, let's call it, temporary situation before, a full-on region comes. So really interesting developments. I think it's a, really, again, it really gives you a lot of clues as to how Hyperscale is going to build across many different opportunities, markets which present interesting opportunities in the region. Next slide. And just continuing on with hyperscale demand, and of course data center operators that are chasing and pursuing that opportunity, we're starting to see shifts in terms of strategies. Hyperscale, when it emerged, a lot of the kind of initial kind of wins and deployments for operators could have been, you could argue, was somewhat opportunistic. You had the location, you had the capacity, you could accommodate that kind of deployment. Obviously, hyperscale started to take off. The competitive landscape got much more intense. Now, everybody's, the thing about hyperscale is it's a very elite and short list of opportunities, of providers, and hence opportunities. But that doesn't mean data center operators aren't thinking about how they can, pivot, differentiate, or pursue, kind of be opportunistic and pursue openings in the market. I think one of the obvious ones is obviously, especially applies to a region like the Asia Pacific, which so many different countries and so much diversity. Being able to serve a hyperscale customer in multiple markets, giving them some scale and efficiency in how they deploy is definitely one thing that we're seeing. Something like an STT Global Data Centers, PDG, has had success operating in multiple markets. But we're also seeing things where it's not things, sorry. We're also seeing situations where operators are positioning or almost anticipating scenarios where they may be able to, kind of walk the line between pure speculation, speculative building, and having a customer in tow. Instead, kind of trying to anticipate and understand how hyperscalers build. They like to build in threes. Microsoft is now doing that as well in all new markets it enters. 3 as in 3 availability zones, but of course those have to be geographically diverse. So you're seeing operators kind of position around, hey, where do I think the main cluster is? Where do I think the second and third one may be, as the need to diversify starts to play out in a specific market. And of course, the thing with hyperscale, hence the term hyperscale, the growth is just so phenomenal. Has been proved out for many years, and again has accelerated during this last during this 2-year pandemic. You're seeing just more scenarios where hyperscalers tend to miss in terms of their target, so they find that they need more capacity. And you're seeing companies like Facebook who prefer to self-build, for example, in the US, taking a huge deployment with QTS in a region where they needed capacity, but simply did not anticipate how much it needed, and did not, for whatever reason, didn't have that on hand, and so had to use co-location. So again, that's the scenario around anticipating, positioning both in terms of having capacity or being in the right market. A stack infrastructure is a really interesting example. They seem to have that kind of a part that's an element of their strategy, and they are a recent entrant. They're primarily in the US and now in Canada, but they've entered the APAC market and could be looking to implement those kind of strategies. Again, trying to, given that they have relationships with hyperscalers, understand the way they deploy, and trying to take that information, that knowledge, and trying to see if they can find some of these openings in the marketplace. So I think these will be really interesting dynamics in the market as as operators go after kind of the shifting and the stop and go of hyperscale demand based on just how they deploy and how fast they are deploying these days. So definitely Southeast Asia is a place we're paying a lot of attention to, and it has some unique qualities. And we would argue, or at least I would argue, is going to be kind of that next frontier in terms of growth in the APAC region. Just as a quick data point, the Alibaba Cloud business is growing at about 40% in this region, and I think it's not just the demographics. Indonesia being the fourth largest population in the world, and then combining with several large countries, all with great underlying fundamentals in terms of eyeballs, mobile usage, upside in terms of potential adoption. But you're seeing other dynamics here, such as the fact that there's less kind of a geopolitical backdrop here. And so, in certain markets, that would preclude what is significant hyperscale demand coming from the China-based clouds. So you're not seeing a ton of expansions, a lot of Chinese cloud hyperscale colocation consumption in North America and Europe, but you are seeing them taking their global efforts into the Southeast Asia region. So you're seeing in a market like Jakarta, for instance, a very large market already has presence from live deployments from three of the largest Chinese hyperscalers, as well as three, if my math is correct, three of the US hyperscalers. So that's a significant amount of demand. And I think you'll see, if we move to the next slide, I think another driver of hyperscale demand that we're starting to see emerge, and is also kind of pushing into the APAC region and Southeast Asia in particular, is what we like to call subscale cloud providers. And subscale, no negative connotation there, just at a scale that is not, and not at the hyperscale level. And so you're starting to see, Naver is a really good example. I think they're around $250 million in revenue now, mostly coming out of Korea. And now they're looking to expand their footprint across Asia. And as you'll see, a number, kind of a footprint split between the core JASH markets, as well as some of the emerging markets in Southeast Asia. Naver is just one example that's local, but I would point many of you to some of the subscale guys in the US that are really starting to get serious about global markets. One of them, DigitalOcean, traded on the public markets. Another one, Linode, was actually just acquired for $900 million by Akamai. And they have small footprints in the Asia Pacific region, but consistently point to having stronger growth coming out of that region. They have just not reached the level of scale or had the resources to expand. They are getting there. DigitalOcean on the public markets, Linode now backed by Akamai, who already has a footprint in the region, and you should expect that to be representative of another source of hyperscale type of colocation, hyperscale level colocation demand, at least in aggregate. And when Jabez talks about those edge hyperscale consumption levels, I think that's where subscale fits in places like where they've had success, India, Japan, Singapore, and many of them, really optimistic about what's happening in Southeast Asia. So I'll finish up with just a few quick slides that came out of our report last year on just kind of the M&A landscape and the overall strategic landscape in APAC. I think the backdrop here is obviously this market continues to grow, as you saw from Jabez's number. Hyperscale demand shows no signs of slowing down. We are seeing other sources of demand, subscale cloud being one of them. You could argue other social media platforms such as a Facebook, or I guess it's called Meta now, as well as ByteDance and TikTok, and as well. I don't think we're going to talk too much about the gaming sector, but that's, I know, a favorite topic of Jabez's, and also a driver of demand. So definitely, we continue to see just an incredible amount of investment interest. Excuse me, investment vehicles being set up, new companies being formed. This is probably already going to need an update, this slide. Some of these, I think one of the very interesting things is that because Asia is so so unique, has so much diversity. You see a lot of joint ventures, a lot of operators, those that come from the United States, those that come from maybe outside the sector, are looking to kind of combine and merge expertise to tackle these increasingly difficult opportunities in very challenging markets. So, Jabez, if you flip to the next slide, excuse me. You'll see in places like India and places like Indonesia, there's been a lot of joint venture activity. And some of these joint ventures have also moved, like with Equinix and GIC, into multiple markets. This summary also includes just some US ventures as well. Sorry, Jabez. So yeah, these are just a snapshot of some of the new companies we've seen formed in the last year pursuing the hyperscale opportunity on a global basis. I think you'll see 4 of them here, targeted around Asia: Digital Edge, Empyrean, Evolution Data Centers, Data Center First. So definitely, I think this speaks to the size of the opportunity as it continues to expand, not just in terms of scale, but in terms of expanding across into that second tier of emerging markets and eventually a third tier. So I'll stop there and let Jabez talk through some other hyperscale topics.
Yeah, so I think before we move on, we're just over halfway through the presentation, and we're gonna wrap it. I won't take too long for the second half, but we'll look to have another 10 to 15 minutes after we're done to answer any questions that you may have on the presentation. So if you have any questions, feel free to put it in the Q&A section, and then we'll try and address it during the 10 to 15 minutes Q&A after we're done with the slides. But just quickly, talking about the moratorium in Singapore and what's been happening since the government has recently provided some additional insight onto the resolution of it. So wanted to quickly talk about what we're seeing. This is a quick timeline of events that have happened since the moratorium was essentially started in Q2 of 2019, mid 2019, where there was a closed door session with government agencies and industry players to kind of pause data center building. And then in 2020, a Business Times article confirmed the moratorium that was in place. And then recently, last month or earlier this month, the government, in partnership with SG Tech and other industry players, have came out with a new pilot phase program that's being put into place, and it's looking to start in Q2, which is just next quarter, and it's going to be a 12 to 18 month program that will last until Q4 2023, around that time frame. And so what does the pilot phase entail? I think a lot of you have seen the reporting around it from various media outlets, but in essence, there's a timeline component to it where starts in Q2, lasts for 12 to 18 months. On the capacity side, the government is allocating 60 megawatts of critical IT load capacity that will be allocated to up to 3 new data center builds, subject to an application selection process. So that's roughly 20 megawatts per build if you do the math. So what are the application selection requirements that are in place? I think the clearest one that they've put forward is the 1.3 PUE that all new builds have to conform to. And then there's also a less vague component to it in terms of submitting a call it sustainability and innovations plan, how your data center build is going to benefit the Singapore economy. How's it going to be sustainable in terms of making use of efficient data center infrastructure and deployment methods, and potentially the use of renewable energy. And then other media outlets have reported that applicants that have a previous track record of operating and building data centers in Singapore will be considered favorably. So these are sort of the key components that we've extracted from the recent announcement. We wouldn't necessarily call it a lifting of the moratorium, but more of a limited easing of that moratorium. And so what does the timeline look like? We've put together what we think is a projected timeline of events that may happen from this moratorium pilot phase program. So we're looking at roughly a Q4 end of this year for the first data center build to be awarded. And so typically once that has been awarded, there's a roughly 18 to 24 months time frame for a new build to come online. So you're looking earliest a Q1 2025 timeline for the first pilot phase data center build to come online. It is unclear if they will stagger the remaining 2 applications or remaining 2 approvals for the other 2 data center sites, or if they're going to award all 3 at the same time. So that remains to be seen, and we can only speculate as to how that's going to look like. But I think in the meantime, another interesting angle is that there's what we call, and Phil mentioned it earlier, is the overflow markets to Singapore that we've been tracking in terms of Batam, Indonesia, and Johor, Malaysia. And there's new builds that are happening in that market that are set to come online in the 2024 timeframe. So it'd be interesting to see how that dynamic plays out between the overflow market builds as well as the pilot phase program builds that are happening in the Singapore market. There's a sizable amount of capacity coming online. From both the Johor and Batam market, you have very established players that have built a very strong reputation for doing business with hyperscalers, companies like GDS and Keppel, and then you have sort of relatively newer market entrants like Data Center First and Bridge Data Centers, or part of the Chin Data group, that are also investing in building capacity in these overflow markets. So this is a quick snapshot of what we're working at here at Structure Research, and you'll see a report that's covering the intricacies and details around those 2 overflow markets coming up in the next couple of months. So do look out for that from us. And now I wanted really to shift to just overall hyperscale, build to suit, build versus lease, and leasing dynamics. As you can see here in the APAC region, this is roughly the capacity sizing ranges that we're seeing from the top 3 hyperscalers, or at least the US hyperscalers, given that a lot of the Chinese players outside of China don't really use built to suit as a deployment model just yet. They're mainly doing sort of your traditional hyperscale co-location leasing from third-party operators. But as you can see here, AWS has we think has the highest appetite, or the highest tendency to do these built-to-suit arrangements, given how mature their platform is and how they tend to also self-build in many of these markets that may not yet have hyperscale-grade colocation capacity. And then you have Azure and Google also doing self-build across the APAC region and doing it on a selective basis. Google doing it notably in markets like Taiwan and Singapore, and you have Azure doing it in markets like Singapore as well. They've acquired land in Sydney for self-build, and they've done self-builds in Busan and South Korea as well. So yeah, there's no sort of tried and true formula for every hyperscaler. I think they do approach each of these markets on a case-by-case basis and take into account all the specific nuances in terms of their demand profile and risk reward and political stability, access to renewable energy, and all of the things that we'll discuss later on in terms of how hyperscalers think about deploying in these markets. And if you look at it from a self-build angle that I discussed earlier, I think the only other company I would add here is Meta, or formerly known as Facebook, where they've done a self-build in the Singapore market that's around 120 megawatts of IT load capacity from what we understand. Could be larger, but I think conservatively, I think 120 megawatts is a safe number to put on that self-build. And then you can also see here that AWS, AWS, Google, and Microsoft, similar to the build-to-suit graph that I showed you earlier, display the same type of tendencies in the self-build aspect as well. And this is not just happening in Asia, but also in markets like Europe, where you're seeing self-builds happening in climate-friendly markets like the Nordics, and also sort of emerging markets in Spain as well that our team is tracking. So just to put it all together, how did the hyperscalers think about building themselves versus leasing from co-location providers? We have sort of these, this chart can be a little bit confusing because you see sort of 2 arrows pointing in opposite directions. So you're thinking, what does that mean? It's just a way of characterizing there's a constant sort of tug and pull between a hyperscaler's propensity to either lease capacity from co-location operators, which is why the arrows are pointing to the left and towards the y-axis, is because we've seen Microsoft being very, very liberal in the way that it leases data center capacity from co-location providers across markets in Asia and Europe. But also you have companies, hyperscalers that are also very prone to self-build, and they've consistently shown the appetite to self-build, such as Meta and AWS, Microsoft and Google. While they do self-builds, they will be a little bit more selective on the type of markets that they self-build in versus AWS and Meta. And then on the lower left-hand side of the chart, you have sort of the lower end of the hyperscale cloud players from the US side, as well as the Chinese hyperscale clouds, which are not small by any means, but the deployment models that they've chosen outside of China has been fairly predictable in the sense that they have primarily leased co-location capacity from data center operators. They have not chosen to self-build in markets outside of mainland China, from what we understand. So that may change moving forward, but for now, this is sort of the dynamic that we're seeing from the Chinese hyperscalers in comparison to the large sort of US-based cloud providers. And so what do hyperscalers sort of look for in markets where they think about whether to self-build or lease? Let's start with the self-build aspect, which roughly accounts for 30% of their infrastructure, data center infrastructure. They try to make it more 50-50, but due to a limited team, how fast they're growing, and the constraints in some of these global markets that they operate in, the self-build aspect of their business happens roughly 30% of the time in terms of capacity. And they really look at, okay, they do want to be in global hubs and tier one markets, ideally, a lot of eyeballs, high population density, markets where there's really good subsea international connectivity. So aggregation hubs like Singapore is a prime example of why there's a notable amount of hyperscale self-builds there. Availability of hyperscale grade colo capacity is also a consideration, which is also why Google likely chose Taiwan to self-build, given that there's no availability of truly hyperscale grade colo capacity in the Taiwan market. Government incentives are also a big reason of why hyperscalers choose a certain market to self-build, and that's seen across the US and other parts of the world as well. Can they get access to large subsidized plots of land? Are there tax benefits in terms of import-export taxes? Is the government there stable from a political regime standpoint? Low risk of regulatory restrictions are all considerations that they consider in terms of self-building. And increasingly so, there's the renewable energy aspect, where they look at power costs, access or availability of renewable energy, how stable or reliable is the power grid in that market. And then sort of non-related to energy is the availability of a skilled talent pool that they can tap into to hire for the development of those sites. So all that kind of goes into play when it comes to self-building. On the leasing side, as they think about leasing from third-party operators, there's kind of sort of three main aspects that we can kind of segment into. One is the data center provider side. Is the provider a single market provider, or do they have a multi-market global regional focus that the hyperscalers can tap into that single relationship to get access to many markets across the world to satisfy their needs? Existing relationships definitely play a part in their decision-making process. They do like to work with providers that are well capitalized with long-term horizon approach in terms of thinking about the balance sheet and returns over the long period of time, which is why you're seeing a wave of sort of land developers, infrastructure funds, infrastructure asset investors coming to the mix, because they are very well capitalized and they do have ownership of renewable energy assets across the world. They do have a long-term horizon, and so that plays well into that hyperscale sort of comfort level as they look to lease capacity. Obviously, operational track record plays a big part of it as well, in terms of being able to deliver builds on time with consistent quality, good supply chain management, and increasingly so a commitment to sustainability and renewable energy. On the location side, you're seeing hyperscalers choose locations with geographical redundancy. There's a certain distance that each AZ needs to be from each other to provide certain level of redundancy and risk tolerance. They like to land bank and the ability to work with providers that can develop in newer, emerging, more riskier markets is also a consideration. Scale, another big one. I talked about land banking, but also that's why you're seeing increasingly providers choose to build in a campus type of way, where you can set up separate dedicated buildings for build-to-suit arrangements or co-location arrangements, and the ability for flexibility on the capital side, where providers are able to move on with the fit out and development of a site without a signed pre-commitment, is also something that's been a very tricky part to navigate for the industry over the last 2 years. And all of that is wrapped into competitive pricing and the TCO model as they decide, is self-building more attractive from a TCO standpoint, or is leasing more attractive? That also comes to play. I won't beat on this thing too much because a lot of this is we've kind of covered it in the previous 2 slides, but it's essentially a flywheel effect where if you check all the boxes and you have existing relationship with the hyperscalers, that tends to create a very kind of robust and healthy flywheel effect where the hyperscalers are more comfortable working with a certain provider. They're able to share their inventory and capacity planning for future AZs and create these sort of global service agreements that they can, because sometimes these onboarding and legal processes when you deal with the hyperscalers can take a lengthy amount of time, so 5, 6, 7 months and even longer to just get onboarded into becoming a registered or registered vendor for them in terms of producing data center capacity. So I do think that as this market begins to mature, it does favor larger global regional providers that do have very deep relationships with hyperscalers across multiple markets. But that being said, there's still a lot of room for new market entrants to show up in and do well in a lot of these underserved emerging markets across the world. And I think this is our last slide, so I'll just keep it short. Some key takeaways that I probably don't need to reiterate. We've already covered that at length throughout the presentation, but essentially hyperscalers will sort of deploy a mixed strategy given how fast they are growing. A lot of them are accelerating in terms of growth from a cloud standpoint. And so being able to catch up with the demands for cloud infrastructure capacity is something that they are constantly adapting to. And you'll see this often tension between self-build and leasing continue to play out over the next 3 to 5 years as they sort of still need to be expanding rapidly in both existing and new markets, and they do have to partner at some level with both operators as well as land developers and many different types of infrastructure vehicles to get that capacity in market. So I'll stop there and move into Q&A. But before we do that, again, really want to give a shout out to Digital Realty for sponsoring this webinar and bringing this content free of charge to the community. And we're really glad that we can share all these insights with you guys. So I'll stop there. And Phil, not sure if you've been monitoring the Q&A, but if you want to start with some of the questions that you've seen, we can kick off from there.
Yeah, no, happy to, and thanks for the great insights. Just everybody, if you want to throw in a question, feel free to put it into the chat window. There also is a Q&A app in Zoom. 2 questions have come in again around the moratorium, so we'll throw them at you, Jabez. I think your explanation of what's going on and the potential of overflow as one of the beneficiaries of the moratorium. One of the questions here is, who, I guess maybe I'll just kind of adjust the question, but who else may benefit? What other entities may benefit from the moratorium? Just kind of in general, based on what you're seeing now in terms of the regulations and how that may impact the ability to, I guess, get permitted to build.
Yeah, that's a good question, Joshua. And I think that ultimately the Singapore government will want to appear in a way that's fair in terms of its decision-making process in granting those new builds. So I do think it'll be a fairly a neutral approach. I don't think they'll allocate all 3 builds to Singapore companies. I don't think Keppel, STT, and another Singapore company will get all the builds. I think they do want to show that, hey, we do also want to be fair to the international operators, the regional operators as well. And also, I think what people may not also realize is that the hyperscale clouds themselves may be part of this process. So I wouldn't be surprised if one build goes to a Singapore operator, the other one goes to an international operator or regional operator that's not necessarily Singapore based, and then the other the last build may also go to a hyperscale cloud provider for a smaller self-build or like we were talking about, for them to build their own sort of proximate compute nodes on a self-build basis. So and it's not out of the question, I don't think, because the hyperscalers are the ones that have developed and deployed regional headquarters in Singapore. Companies like Google have deployed a sizable office footprint there and have hired a number of workers in the Singapore market. So that's definitely a plus when it comes to how does, the question of how does your data center business plan benefit the Singapore economy. I think that favors the hyperscalers. So I do think, yeah, it'll be probably a very fair, transparent approach. I think optics matter a lot when it comes to a very highly contested process like issuing data center build applications. So I do think that, yeah, I think it'll be a fair kind of process. But I'm just speculating. I could be completely wrong, but just given my initial take on what's been happening and what I've been hearing from talking to participants in the market, I think that's probably a fair statement to make. I see your second question about crypto miners. We don't spend a lot of time on the crypto side, so I wouldn't have much to add, much credible sort of insight to add, but I will say crypto miners like cheap power. And so anywhere that you can get cheap power at scale is probably an attractive location for them. So Phil, any other questions that you seeing?
Yeah, I can grab a couple of the other ones that have come in and maybe take a stab at the crypto one, but do you want to address the second question around the moratorium? Do you see that one around PUE?
Yes. Okay, I see that. How does the PUE existing data centers compare to the requirement of 1.3? Yeah, no, I think that's a really good question. And I think there's sort of a little bit of, the government wanting to pursue efficiency in data center builds, but maybe not necessarily understanding the scale at which these data center builds need to, how big these data center builds need to be in terms of scale for them to achieve economies of scale and therefore really low PUE. So I think PUEs lower than 1.3 are very, very attainable when you look at a hyperscale self-build, because the hyperscalers are only building for themselves. They can optimize the M&E equipment, the server infrastructure, the densities to exactly for their specifications. And so that's why you're seeing Google and Meta have self-builds in the 1.1 or even sub 1.1 PUE. And so that 1.3 PUE will not be a challenge at all for the hyperscalers to hit. When you talk about a multi-tenanted sort of arrangement for a data center build, where you have to build sort of a cookie cutter template so that you can cater to a variety of customer requirements, I think that's where you'll see that PUE number start to go up into maybe the 1.4, 1.5 range. So a lot of new builds in Singapore have been able to hit that 1.3, 1.4 mark, but I think when you get to like sub 1.2, that's going to be fairly challenging for a co-location operator to achieve. And so that's a conversation that I think a lot of the operators are having with the government entities to level set on, being able to achieve that PUE number in a sustainable way, but also doing it while not having the scale of capacity to achieve economies of scale on that front. So it is I think a moving target, and I think there will be more discussions made, more of an open forum between the providers and the government agencies to figure out the best way or best approach to satisfy those efficiency requirements.
Great, thanks. Let me tackle some of the other ones here and give you a breather for a second to see if any other questions come in. Just a quick thanks, Damien, for the question. We are in the process of gathering that intel. I would say we've had some conversations, some interesting ones that will hopefully address that topic lined up. If you want to check back with us, we're hoping to finish the research process in about 3-4 weeks and then publish, in 6 to 8 weeks. So definitely love to hear from you again, and hopefully we could have a little more to talk about, at least for that specific question around connectivity. Let me jump back to the crypto question. Let me try to take a stab at that. As Jabez said, we don't spend a ton of time following the cryptocurrency market. I would argue it's developing a little outside the traditional co-location data center market, just given the operating model. The customer expectations are very different, and a lot of data center operators, we actually know a few who kind of dabbled in it, but most operators just find it, shall we say, not a great fit with the value proposition and operating model and business model. We have not come across much demand, like any, conversations or chatter around cryptocurrency, a potential cryptocurrency location in Asia. Based on my early observations of this category, I think maybe that's because there's not a lot of favorable climates. Asia is generally warm. A lot of the crypto activity we've seen in Canada, actually where I am, and in the Nordics, and these places have, large, at least Canada has, plenty of land and less people. It's also extremely cold. It's minus 11 Celsius outside right now where I am. There is a green power, and then of course the climate is kind of a cheap way to cool infrastructure, because generally with these customers it's all about power, not really about performance, and it's about driving the cost down as far as possible. So yeah, I don't know if we'll see anything in terms of your other question too. I'll lump them together. I mean, I think I wouldn't expect to see much around the crypto market in Asia in the foreseeable future, and I don't know if it'll even cross over into this sector, data center co-location. As for digital passports, that's an interesting one. I hadn't given that much thought, but I think that seems pretty far off, given that computing workloads tend, I think we're just in the early stages of having them separate, and that's kind of this whole conversation around the edge and distributed computing. And so, and of course the Batam Johor conversation, I think that's, if it's going to serve as a Singapore overflow market, that would entail, infrastructure being, data and being hosted outside Singapore. So if it's sensitive or needs to be in country, that would cross the jurisdictional line. And so the natural byproduct of that, one would think, would be that you would have obviously less compliance sensitive workloads, and that's kind of, or processes done, and then kind of sensitive data stored in the core, in a core market. So that separation, I think, is, we're still, I think the market is still, and the hyperscalers and the clouds are still struggling with how to do that. So something as sophisticated as a digital passport in order to tag a workload seems far off, to say the least. Yeah, those would be my answers to those. Jabez, there's a couple more coming in. I haven't scanned.
Yeah, there's one coming in from Jose. Hey, Jose, how's it going? Good to hear from you again.
How you doing?
He had a good question about, do we see any markets like a Singapore or Amsterdam where moratoriums might occur? And that's a really good question, because that really kind of affects the supply-demand dynamic a lot in those markets. I've heard rumblings of maybe some sort of moratorium brewing in the Seoul, South Korea market, although it's maybe a bit early days for that, given it's still fairly nascent in terms of international data center infrastructure capacity being deployed and built in that market. I think Hong Kong eventually may think about a moratorium, given its land constraint and shares very similar characteristics to Singapore. But yeah, outside of that, we haven't heard of any market in APAC per se that has the appetite to enact a moratorium similar to Singapore. I think a lot of countries are kind of watching closely at the after effects of a moratorium, like what Singapore and Amsterdam have done. Amsterdam also recently sort of did a moratorium 2.0 to restrict builds moving forward. So we wrote some commentary on that in our research, but yeah, outside of that, we haven't heard of any notable markets where we're seeing moratoriums take place. But yeah, really good question, Jose. Any others that you see, Phil?
Deddy has a question around cost per megawatt builds. I would say the best way is to access our research based on on the markets that we have detailed information for. You can check out our website, and we lay out some of that data, some of those insights there.
Yeah.
Okay. Just a comment that PLDT.
Yeah, we did see that PLDT announcement
yeah,
come through. Thanks, Eduardo.
Yeah, and I guess maybe just, I think the idea, the digital passport, I think Joshua kind of mentioned that. I think what he means is, basically kind of an ID for a certain kind of workload or data to be permitted to leave its jurisdiction and kind of be hosted near shore or offshore. Anyway, that's how I took it. That's how I answered the question. So.
Yeah, I think
Cool.
Bowie Chan had a question about
yeah.
PUE, improving PUE, and how we think how we think the adoption of liquid cooling could impact that. So yeah, I think liquid cooling is definitely a very interesting aspect as densities start getting into that 15, 20, 30, 40 kilowatts per rack level. A lot of the hyperscalers are at the forefront of pushing densities to that high levels, especially when you talk about certain HPC applications that they're running. Universities too, right? Like research institutes and universities are experimenting with HPC applications. And so, yeah, I do think that liquid cooling is a very viable cooling method to efficiently cool these high density servers. It has yet to be adopted on a large scale or in a mainstream format, given most sites are traditionally air cooled. But I do think that over time that you'll see more and more adoption of liquid cooling, and it just remains to be seen how many years it'll take before that immersion liquid cooling methods become mainstream. But definitely something that we've noticed come out more and more in conversations with and tied into hyperscale deployments and HPC deployments.
Yeah, maybe I'll throw in just a quick bit of feedback. I mean, maybe to be a little devil's advocate. I mean, and based on some of the things that I have seen, I think you may see liquid cooling emerge in maybe first in smaller scenarios. And what I mean, like in these kind of smaller edge compute sites, even container size, but just basically smaller, more focused deployments where, it's a smaller increment that's serving us a very kind of, perhaps a very power intense workload where this kind of scenario might make sense. And also, given it's smaller, I think that may anyway, it facilitates more ability to experiment. And we have seen some of these kind of test cases here in North America.